Hi, I'm Jared Nelson from the Investing Channel, and welcome to Markets and Minds, the show where we break down big macro themes into simplified trade ideas. Now, business and businesses are constantly evolving, so it follows that the way we value or rank a company or investment idea should evolve as well, and indeed it has. We only have to look to social media and the rise of trading communities to see just how quickly new information can be shared and opinions formed. Opinions that can rightly or wrongly dramatically affect a company's share price. However, the fact that a large group act together to buy or sell a particular group of stocks isn't a particularly nuanced approach. It can be a very effective one, though not necessarily over the long term. The use of alternative data in investing and trading has been growing steadily over the last decade as money managers look for a trading or informational edge and new ways to understand the increasingly complicated and integrated world around them. That process was only hastened by digitization and the growth of e-commerce and online services. And today there are very few things that can't be done online, and with the emergence of super-fast 5G networks and the IoT, or Internet of Things, that list of offline-only tasks is likely to shrink even further. Of course, as we do more online, we create data and leave footprints. And as more services become available to us digitally, we are able to track our actions both individually and collectively. Have you ever looked at your location tracking data on your smartphone? It can be a real eye-opener about just how and where you spend your time. That's interesting enough on its own, but during the pandemic, anonymized location tracking data at scale allowed Wall Street analysts, money managers, the government, and anyone else who was interested and had access to track consumer behavior and to compare that to activity levels pre-COVID. That data could often be overlaid with credit and debit card spending data to provide a pretty clear picture of how the consumer and the economy was adapting to life under COVID-19. U.S. consumers, of course, account for as much as 70% of the country's GDP, which stands at approximately $21.4 trillion per annum. If you could see where people were going and where they weren't, and where they were spending their money en masse, then you had a pretty good basis to decide which businesses were doing well and which were in for a very tough time. What's more, you were also likely to be in a position to spot changes in those trends which could indicate a return to normality. On top of this data, traders made use of satellite photography and of ship and flight tracking services, which they combined to form a picture of what was literally happening on the ground across the globe. The use of alternative and big data to support and in some cases to drive trading and investment decision is now well established. The next stage of this journey will be to use alternative data to create an alternative view of companies' worth or value, away from the balance sheets and quarterly figures. Two recently published surveys shine a light on exactly how this process could work. These surveys dealt with two separate but overlapping areas. The first was brand value, and the second was digital maturity. Both surveys found that these intangibles can and do have a direct effect on the valuations and share prices of the companies surveyed. Market research specialist Kantar published its Brand Z Top 100 Most Valuable Brands report, and management consultants BCG its latest Digital Acceleration Index on the same day. BCG's report talks about digitally mature or bionic businesses. That's not a throwback to 1970s sci-fi, but instead, it's a description of an enterprise that manages and melds its technology and human capital together. Not to create cyborgs, but to create an efficient business where each of those elements plays to the strengths of the other. These bionic companies are investing in technology and are putting AI, or artificial intelligence, at the heart of their operations. BCG found that digitally mature companies outperformed their peers across 9 performance indicators, including revenue growth and enterprise value. What's more, within 6 months of the pandemic, the valuations of this group of companies were on average 23% higher than their pre-pandemic level. Turning to Kantar's 100 Most Valuable Brands report, in total, the top 100 brands have a value of $7.1 trillion. That figure rose by 42% last year, more than 4 times the average annual increase in brand value seen in the last 15 years. Brand value is distinct from the value of the business that owns and manages a brand, but is a component of that. And for the biggest brands, that value is significant, with both Apple and Amazon's brands being valued at more than $500 billion each. We can think of a brand's value as being a subset of the equity value of a business. Equity is often described as the value of the business over and above its physical assets, inventory, investments, and cash at the bank. It includes intangibles such as goodwill and shareholders' expectations for the future, but increasingly that equity can be boosted by the perception and performance of its brands. Boosting those brand values over the last 12 to 18 months has depended on how well a business transitioned to trading in the pandemic, which for many firms meant switching to e-commerce and remote working. Luxury goods businesses were very adept at doing this, and overall the category saw its brand values rise 34%, and briefly made LVMH owner Bernard Arnault the world's richest man. Kantar research found that the share prices of companies that owned the top 100 brands recovered twice as fast as those of companies with lower value brands. The ability to pivot to e-commerce and remote working efficiently depended on just how digitally mature a business is or was and how well it understands this new environment. For investors, being able to identify businesses that are growing brand values and becoming digitally mature or are embarking on that path, and separating those from companies that are not, is likely to become a very valuable and sought-after skill. That's all we have time for this week, but as usual, make sure you do your due diligence before making any investment decisions.